In this video we are going to talk about false break, or fakey trading strategy, that can help any Forex or stock trader to avoid deception in the market, and how to take advantage of it, and be a successful trader.
Subscribe to this channel for more videos so that you don't miss any update. And don't fail to hit the like and share buttons so that your friends can see it.
When was the last time you entered a trade, and it immediately moved against you, even though you felt confident the market was going to move in your favor? When was the last time you traded a breakout and got stopped out? For sure, you've experienced one or both of these things recently in your own trading, and I am sure somebody probably took the opposite side of one of these trades that seemed to fake you out of your position. You see, false breaks happen all the time in the markets. They are a result of the herd mentality, or collective behavior that causes people to buy the top of a move, or sell the bottom. As price action traders, we are in a unique position to take advantage of false breaks, and of the weak herd mentality that so many amateur traders possess. Savvy traders made most of their money as traders by using contrarian trading approaches, like false breaks, and fakey trading strategy. It is the power of contrarian trading, and using false break patterns, and fakey setups, that allows few savvy price action traders to profit from other traders' misfortunes.
This may sound a little harsh, but it's the reality of trading that the majority of traders lose money, informed and skilled traders make money, and the pigs get slaughtered, as the saying goes. I hope there are light bulbs going off in your head now, because this video is all about contrarian thinking, false breaks, and how to take advantage of the herd mentality or collective behavior.
So what exactly is a false break? A false break can be defined as a deception by the market, a test of a level that results in a break of that level, but the market then retracts, and does not sustain itself above, or below that level. In other words, the market does not close outside of the level being tested, rather it leaves behind a false break of it.
These false breaks are huge pieces of evidence for impending market direction, and we need to learn to use them to our advantage, instead of becoming their victim.
Essentially, a false break can be thought of as a contrarian move that sucks the overcommitted side of the market out. The concept is to wait for the price movement to clearly show that a market has committed to one side of a trade, and that they would be forced to liquidate their positions on a strong reversal in the other direction.
Typically, we see these scenarios unfold as a trending market becomes extended, and all the amateurs jump in right before the counter-trend retrace, or at key support and resistance levels, or at consolidation breakout scenarios.
The herd mentality or collective behavior causes traders to enter the market typically only when it feels safe. However, this is the deception. Trading off feeling and emotion is exactly why most traders lose money in the markets. Many traders become deceived because the market looks very strong, or very weak, so they think it's a no-brainer to just jump in with that momentum. Types of false breaks. 1. Classic bull and bear traps at key market levels. 2. False break of consolidation. 3. Fakies, inside bar false breaks. We are going to demonstrate these types of false breaks and how you can trade them and take advantage of them. A bull or bear trap is usually a 1 to 4 bar pattern that is defined by a false break of a key market level. These false breaks occur after large directional moves, and as a market approaches a key level.
Many traders have a habit of thinking a level will break just because a market has approached it aggressively. They then buy or sell the breakout, and then many times the market will fake them out and form a bull or bear trap.
A bull and a bear traps form after a move up or down. Some traders who were on the sideline watching a recent strong move unfold cannot take the temptation anymore. and they jump in, just above, or at a key resistance level. Since they feel confident the market now has the momentum to break above the level.
The market then breaks slightly above the level, and fills all breakout orders, and then falls lower, as the big boys come in, and push the market lower, leaving the amateurs trapped in a losing long position.
False breaks of consolidation, or trading ranges are very common. It's easy to fall into the trap of thinking, a trading range is going to break out, only to see it reverse back, into the body of the range.
The best way to avoid this trap is to simply wait, until there is a clear close outside of the trading range, on the daily chart.
And then, you can begin to look for price action trading signals, in the direction of the breakout. Like a retest of the key level, with an inside bar.
Then, a clear move up of the market. The takeaway here, is to be patient, and to wait for a clear opportunity to enter, towards a clear direction of the market.
The fakey setup should be a favorite price action setups for all traders, and learning to trade it will do a lot for helping you to understand market dynamics.
The fakey is a price action pattern that requires there to be a false break of an inside bar setup. So, once you have an inside bar setup, look out for a false break.
You can see there was a break of the inside bar.
Then the price snapped back, resulting to a false break, then the price moved up.
You should look out for a false break of the inside bar and the mother bar. Once the break fails, or snapped back, open a trade towards opposite direction. Here is another variation of the fakey inside bar setup. Without a pin bar, you can see the inside bar and the mother bar.
There was a break of the setup by the price, at the key level, which turned to be a deception, because the price pushed back.
Then the market collapsed.
False breaks can create long-term trend changes.
As price action traders, we can use the price action of a market to anticipate false breaks and look for them at key levels, as they will often set off significant changes in price direction, or even a change in trend from these key levels.
We need to pay attention to the tails of candles that occur at or near key levels in the market. Ask yourself how prices reacted during each daily session. Where did they close? The close is the most important level of the day, and often if the market fails to close beyond a key market level, it can signal a significant false break.
Often, prices will probe a level, or attempt to break out, but by the close of the daily bar price has rejected that level, and tailed out, showing a false break, or false test of the level. A failure of the market to close beyond a key market level, can lead to a large retracement or a change of trend. Thus, the close of a price bar is the most important level to watch, and the daily chart close is what I consider to be the most important to look out for. It is the breakout traders that usually fall victim of false break, swing traders do not. Breakout traders always look out for breakout at key levels, range-bound and market consolidation setups, thereby falling victim of false breaks. While swing traders do not look out for breakout, rather they anticipate reversal of the market, at the key levels, and cannot fall victim of false break. Final word on false breaks.
As traders, if we don't learn to anticipate and identify deceptions or false breaks in the market, we will lose money to traders who do. If we pay attention to the price action at key levels on the daily chart time frame, the writing is usually on the wall in regards to false breaks.
If I had to leave you with one crucial piece of advice for your Forex trading career, it would be to drop everything right now and start studying false breaks and contrarian trading approaches. By doing so, you will be ahead of 95% of traders who are stuck in a cycle of trading off mainstream misconceptions and ineffective trading methods. As a contrarian, you want to be trading when most other retail traders are committed to the wrong side of the market, and this is difficult to do if you don't understand false breaks and fakey patterns.
Subscribe to this channel for more videos so that you don't miss any update. And don't fail to hit the like and share buttons so that your friends can see it.
Please drop your comment below.
Thanks for watching.